August 1998. Russia has just defaulted on its domestic government bonds and devalued the ruble. In a quiet office park in Greenwich, Connecticut, two Nobel Prize-winning economists are watching their mathematical models their creators had described as approaching the outer limits of financial science, fail simultaneously across dozens of markets. In a single month, long-term capital management will lose 44% of everything it has. The numbers are almost impossible to hold in your head. LTCM is running a balance sheet of roughly $125 billion, and through its derivatives positions, it has exposure to more than $1 trillion in notional value. All of that sits on a foundation of about $4.7 billion of actual investor equity. When the positions begin moving the wrong way, the mathematics of ruin arrive very quickly. You might think this is a story for billionaires only, something that happened in rooms most people will never enter. But the exact mechanism that destroyed LTCM, the belief that because something has never failed before it cannot fail, is the same mechanism behind millions of ordinary financial disasters. The scale differs. The psychology is identical. By September 23, 1998, the Federal Reserve Bank of New York will summon the heads of 14 of the world's largest financial institutions into a single room and tell them they need to write a collective check for $3.6 billion or risk a cascading collapse that could freeze global credit markets. This is how close it came. The story begins in 1994, when John Meriwether, who had built Salomon Brothers' bond trading desk into one of Wall Street's most powerful operations, left to found long-term capital management in Greenwich, Connecticut. He recruited Myron Scholes and Robert Merton, whose foundational work on options pricing would earn them the Nobel Prize in economics in 1997. The message to prospective investors was unmistakable. These are the smartest people in any room. LTCM's core approach was called convergence arbitrage. The fund identified pairs of securities, often government bonds with slightly different maturities, that should theoretically trade at very similar prices, then bet that any temporary gap between them would eventually close. Each individual trade offered razor-thin returns. To generate meaningful profits at institutional scale, the fund had to run enormous amounts of borrowed capital alongside a small equity base. This is leverage, and it is the engine of both LTCM's early brilliance and its eventual destruction. The early results were extraordinary. LTCM reportedly generated gross returns of roughly 28% in 1994, 59% in 1995, and 57% in 1996. Banks competed to lend to the fund. Investors pleaded to get in. By 1997, investor equity had grown to around $7 billion, and the balance sheet expanded in lockstep. This is leverage working as designed, amplifying gains. The lesson that follows is brutal in its simplicity. Leverage amplifies losses with exactly the same force, in exactly the same proportion, on the way down. In late 1997, LTCM returned roughly $2.7 billion to outside investors, partly because the partners were finding fewer attractive trades at acceptable prices. This reduced their equity base to about $4.7 billion. The balance sheet, funded largely by borrowing, remained around $125 billion. Their leverage ratio had effectively risen to approximately 25-1. The financial concept here is brutal. At 25-1 leverage, a 4% decline in asset values wipes out the entire equity. They were operating with essentially no margin for error. On August 17, 1998, Russia announced a default on its domestic ruble-denominated government bonds and a devaluation of the ruble. Direct exposure to Russian assets was manageable for most Western institutions. What was not manageable was the secondary effect, a global flight to safety. Investors sold anything perceived as risky and flooded into US Treasury bonds. The spreads LTCM had bet would narrow instead blew wide open, and because the fund was running that same fundamental bet across dozens of markets at once, every single position moved against them simultaneously. This is the moment to name one of the most underappreciated concepts in finance: correlation risk. LTCM's portfolio appeared diversified across European bonds, US mortgage securities, equity volatility trades, and more. In calm markets, these positions moved somewhat independently, but in a genuine crisis, correlations collapsed toward one. What looked like 50 separate bets revealed itself to be a single bet, that markets would keep behaving in an orderly way. When that assumption broke, everything broke at once. The pace of the collapse was breathtaking. LTCM reportedly lost around $550 million in a single day in August 1998. By the end of that month, the fund had shed 44% of its capital. By mid-September, equity had fallen from $4.7 billion to roughly $400 million. Years of extraordinary performance erased in weeks. The leverage that had amplified the gains on the way up was now amplifying the losses on the way down with perfect and merciless symmetry. On September 23, 1998, officials from the Federal Reserve Bank of New York convened an emergency meeting. The leaders of Goldman Sachs, Merrill Lynch, JP Morgan, and 11 other major institutions were in the room. The concern was direct. A disorderly liquidation of LTCM's trillion-dollar book into already stressed markets could cascade through the global financial system and threaten the solvency of several of the institutions sitting in that very room. Over the following 18 months, the consortium carefully unwound LTCM's positions, avoiding the catastrophic fire sale everyone had feared. By early 2000, the fund was fully liquidated. Some banks eventually recovered portions of their capital as markets stabilized. But for the original outside investors and for the fund's partners who had substantial personal wealth inside the fund, the losses were severe. The smartest people in the room fund had been wound down by a committee of rivals. The financial system survived, but only barely. The first psychological trap operating inside LTCM is expert overconfidence, and it is worth being precise about what makes it so dangerous. Overconfidence is not the same as arrogance. Scholes and Merton were genuinely brilliant. Their models were genuinely sophisticated. The bias operates not by making someone stupid, but by making them selectively blind, confident in their expertise, where it was earned, and unaware of where that expertise does not actually reach. LTCM's models rested on a foundational assumption that very large price moves are extremely rare, what statisticians call tin tails. Real financial markets behave differently. Extreme events, crashes, sovereign defaults, sudden panics occur far more often than tin-tailed models predict. Nassim Taleb had been arguing this point for years before 1998. LTCM's models said the August events were essentially a statistical impossibility. The models were wrong, and the entire fund was sized as though they could not be. LTCM's extraordinary early track record created a textbook social proof dynamic. Social proof is the cognitive bias where we treat the behavior of sophisticated others as evidence that something must be safe. When major banks and institutional investors saw peers pouring money into LTCM and earning those returns, the question shifted from, is this strategy sound, to how do I get access? The fund's prestige became its own marketing, and marketing consistently crowds out genuine analysis. Related to social proof is the halo effect, the tendency to assume that excellence in one domain extends automatically to adjacent ones. LTCM's partners were world-class at specific mathematical problems in financial economics. That credential created a halo that led investors, banks, and regulators to extend them enormous latitude on questions of systemic risk and leverage. Being right about options pricing theory does not make someone immune to the consequences of catastrophic borrowing, but the halo made it nearly impossible for anyone to say that out loud. As losses mounted through August 1998, the partners held their positions. Their careers were built on this strategy, their personal fortunes were inside the fund, and the models continued to say the trades would eventually converge. This is the sunk cost fallacy in concentrated form. Because you have already lost so much, you cannot afford to stop. That logic replaces, is this still a good position, with, I cannot have been completely wrong, and that substitution costs fortunes. Another mechanism at work was the illusion of control. LTCM ran sophisticated daily risk monitoring, including a metric called value at risk, which estimated potential daily losses based on historical volatility. They had run stress tests. The problem was that those scenarios were calibrated to historical data, and history had not produced quite this configuration of events before. When people believe their monitoring systems are comprehensive, they often stop asking whether those systems are measuring what actually matters most under pressure. As LTCM's fame spread, other funds and proprietary trading desks began running similar convergence trades. By 1998, several large institutions held positions that closely resembled the funds. This created what traders call a crowded trade, many large players on the same side of the same bet. When the crisis hit and everyone tried to exit simultaneously, each forced seller drove prices further against all the others. LTCM was partly destroyed by the very imitation its success had inspired. Herding transforms individual intelligence into collective fragility. Running underneath all of these biases is normalcy bias, the tendency to assume the future will broadly resemble the recent past. LTCM's models were calibrated on data from a period of relative stability. Every difficult episode in recent financial history, including Meriwether's own experience at Salomon Brothers in the early 1990s, had eventually resolved itself. Markets had always normalized. That track record made it genuinely difficult to take seriously the possibility that a dislocation might arrive large enough and fast enough to exhaust the fund's capital before normality returned. There is a final observation worth making, and it is an uncomfortable one. The LTCM story is not about fraud or deliberate deception. Nobody was lying about the core strategy. It is a story about how intelligent people inside a system that rewarded their confidence and scaled their bets built a structure that was fragile by design, and then collectively convinced themselves and everyone around them that the fragility was under control. That is not a story unique to LTCM. It is the recurring story of nearly every major financial crisis in modern history. The first rule from LTCM is this: set a hard leverage limit and treat it as inviolable. If you use margin in a brokerage account, a concrete ceiling to consider is this: never let your borrowed amount exceed 20% of your total portfolio value. At that level, even a sharp 40% market crash does not force you into insolvency. At 25-to-1 leverage, a 4% move destroys you. Write your limit down, somewhere you will see it before you ever click buy on margin. The second rule is to run a real stress test, not a theoretical one. Look at every position in your portfolio and ask, how did this actually perform in 2008 or in March 2020? If most of your supposedly diversified holdings fell together in those periods, you are carrying correlation risk, not genuine diversification. Real diversification means some portion of your portfolio holds value or rises when the rest falls. If everything moves in the same direction in a crisis, you have one position, not many. The third rule concerns credentials and track records. Before committing serious money to any fund, strategy, or advisor, ask one specific question: under what 3 market conditions does this approach fail? If the answer is vague, or if past performance is the entire argument, you have not received an adequate answer. LTCM's investors never seriously asked that question. The returns and the Nobel Prizes answered it for them. Your job is to find the hidden assumption, the thing that must remain true for this to keep working, and decide whether you've actually accounted for what happens if it breaks. The fourth rule is the pre-mortem, a technique borrowed from psychology. Before any major financial commitment, do not ask, why will this work? Ask instead, if this fails completely in 2 years, what are the 3 most likely reasons? Write the answers down. Then ask whether you have actually protected against each of those scenarios, not merely assume they won't arise. This exercise forces you to confront the assumptions you are hiding from yourself, which is precisely what LTCM's partners fail to do. The fifth rule is one of the oldest in risk management, and the one most consistently ignored. Always preserve your ability to stay in the game. LTCM's core thesis was not entirely wrong. The spreads it had bet on did eventually converge, but only after the fund had already been liquidated. The partners ran out of capital before they could be proved right. Whatever position you hold, make sure you can survive a 30 to 40% adverse move without being forced to sell at the worst possible moment. Survival is the prerequisite for recovery. Every great financial disaster in history looked like genius right up until the moment it didn't. LTCM had 2 Nobel Prize winners, 4 years of spectacular returns, and the confidence of the world's most sophisticated institutions, and none of that was enough to bridge the gap between its models and reality. At Reset Worth, we take these cases apart week by week, because the patterns repeat and the psychology is always the same. If this episode gave you something genuinely useful, subscribe right now and join a community that is serious about building wealth that actually survives the moments when everything stops working as expected.